Welcome back. John A.G. here. Today is not a hype video. This is a cycle video. It's about timing, psychology, and what actually happens when a market gets too loved, too crowded, and too confident. Because right now, in precious metals and mining equities, the vibe is shifted. The charts look beautiful. The headlines look louder. The room feels warmer. And when a room feels warm, investors start forgetting what cold feels like. Before we go any further, my YouTube stats keep showing the same thing. Most of you watch, but you're not subscribed. If this kind of breakdown helps you, hit subscribe and drop a quick comment. Even OG is enough to tell the algorithm you value this content. All right, here's the question that matters. Are we watching the middle of a long bull market, or are we already in the late stretch where the payoff is tempting, but the fall is violent? And I'm going to warn you, both can be true at the same time. We're at a Vancouver Resource Investment Conference, sitting down with a panel of veterans, people who have lived through multiple booms and multiple collapses. These are not first-time tourists. These are the people who've seen the same movie, just with different actors. Joining me are three voices. One is a cycle historian who has watched metals for half a lifetime. One is a company builder who has raised money in both droughts and floods. And one is a macro thinker who connects the metal chart to the currency chart. No fanboy takes, no influencer vibes, just scars, experience, and a little bit of dark humor. And I want to start with the blunt statement that kicked off the whole discussion. One of the panelists didn't ease into it. No soft language, no hedging. He looked at the current market and said in plain terms, this looks like a bubble. Not could be, not maybe, bubble. Now let's be careful. A bubble doesn't mean tomorrow it crashes. A bubble means the emotions are running ahead of the fundamentals. It means the pricing is beginning to assume perfection. It means the market is rewarding stories faster than it can verify reality. And once that happens, the next phase is always the same. The market starts testing people. It tests their conviction. It tests their liquidity. It tests whether they can handle drawdowns without panicking. So the first theme is froth. The second theme is discipline. And the discipline conversation starts with profit taking, something that sounds easy in theory and feels impossible in practice. When someone says bubble, what do you actually do with that? Do you run for the door? Cycle historian. No, you respect it. You don't get dramatic, you don't go all in, you don't go all out, you tighten your process. Because in a frothy phase, the market will still give you upside, but it will charge you a higher emotional price for holding it. John Egg. Meaning? Cycle historian. Meaning volatility, meaning fake-outs, meaning days where you feel like a genius at 10 a.m. and an idiot at 2 p.m. And then the company builder jumps in and he's smiling because he's seen this pattern. Company builder. People think a bubble is a one-day event. It's not. It's a mood. It's a season. Sometimes the season lasts longer than you think, but the end of the season is almost never gentle. So we ask the obvious follow-up. John Egg. Okay, if it's a season, how do you survive the season? And that's when one panelist delivered a simple framework that a lot of viewers need to hear. He said, take some money off the table while you're still happy. Not because you're bearish, because you're human. He described trimming a portion, around a quarter, of a position during a melt-up phase with one goal: recover the original capital. He didn't claim magic, he didn't claim perfection, he described risk control. And I want you to notice why this works. When you pull out original capital, you don't just change your balance sheet, you change your brain. Your brain stops screaming at you when the market wiggles. Your brain stops bargaining with you when the market dips. Your brain gets calmer, and calm brains make better decisions. Now I can already hear the comments, but if I sell, it'll go higher. Yes, sometimes it will. The point is not to be right on the next candle. The point is to avoid getting wrecked on the next cliff. Because late cycle markets don't kill people with bad ideas. They kill people with no exits. Let's zoom out because the panel kept circling around this idea that the feel of today is different. I asked them the most important question in a bull market. What's different about this time? And the first answer wasn't technology. It was experience. Cycle historian. In the big 1970s boom, most people didn't have a memory bank for how these markets behave. Extractive industries had been out of fashion for so long that a lot of participants were basically learning on the fly. John A.G. So you're saying this time the crowd is smarter? Cycle historian. Smarter, maybe. More experienced, definitely. A lot of the people here have lived through multiple runs. They know the emotional arc. They know the moment where greed turns into reckless. They know the point where I'll just hold a little longer becomes I can't believe I didn't sell. He then listed the cycles people have lived through, the 1970s type run, an early 1990s wave, and the 2000 to 2010 era where metals and miners had a long stretch of strength. And he made a prediction that sounds simple but matters. People with experience tend to leave a bull market with at least some cash intact. Beginners tend to round trip. That's not an insult, it's a pattern. Then the second, what's different, answer hit even harder because it affects everyone watching this video. Another panelist said, "The internet turned the market into a live arena." Back then, you might have waited for George Cross newsletter or Northern Miner. You might have read a weekly recap. You might have made decisions with a lag. Now, the data is instant. The narrative is instant. The reaction is instant. You see a drill hole headline. You see a chart spike. You see a thread explode. And you can buy in 15 seconds. That is powerful. And it is dangerous. Because speed doesn't only speed up opportunity. It speeds up mistakes. It speeds up hurting. It speeds up panic. And when panic is fast, drawdowns are sharp. Here's a cliffhanger you need to hold on to. In a minute, I'm going to show you the one psychological switch that flips a healthy bull market into a destructive stampede. But first, we have to talk about prices, because prices change how people behave. The company builder leaned back and said something like this. Look at where we are. Silver around $100, gold around $5,000. If you said those numbers out loud a few years ago, people would have laughed at you. And the builder admitted, he had heard the extreme predictions, but he never truly expected them to arrive in real life. That matters, because when reality catches up to what used to sound impossible, people become overconfident. They start thinking, if that happened, then anything can happen. And yes, anything can happen. But the market has rules. The market is cyclical. Metal prices go up and they go down. Supply reacts. Demand reacts. Substitution happens. Capital rotates. Sentiment swings. So the panel kept repeating the same warning in different words. This is not early innings. It feels late. But late doesn't mean finished. Late means you should stop acting like you have unlimited time. Then the cycle historian brought up an old lesson, an anecdote about regret. He said he once saw a bumper sticker in Alberta oil country that basically begged the universe for one more bull market, with a promise to behave better next time. He was laughing when he said it, but he wasn't joking, because regret is one of the most expensive emotions in commodities. Regret makes you chase the next cycle too late. Regret makes you hold the current cycle too long. So the panel's advice was not be scared, it was be awake. Now, remember the cliffhanger I promised? Here's the switch that flips healthy into destructive. FOMO, fear of missing out. One panelist said he has looked at an absurd number of portfolios over decades, tens of thousands, and the most common damage doesn't come from ignorance. It comes from FOMO. FOMO makes you buy after a run. FOMO makes you refuse to trim. FOMO makes you add leverage because you think you're late and you want to catch up. And when the inevitable correction hits, leverage turns normal volatility into forced selling. That's how bull markets create victims. Not because metals are evil, because humans are predictable. So if we're talking about retention and survival, we have to talk about drawdowns. Another veteran said, don't romanticize this. Even inside a major secular bull market, you can get brutal drops. He referenced how, in the middle of a strong 1970s-style advance, gold still fell about half at one point. Not at the end, mid-run. One analyst said, look at the charts, especially the GDXJ chart from 15 years ago again. And he said, bluntly, if you're not prepared for 30%, 35%, even 50% declines in the equities, then you need to get some money out now while you still can, because you will feel those declines if you stay in the game. That's not pessimism, that's realism. Then he used my favorite metaphor of the day. He said, treat this bull market like a rodeo ride. You're the rider. Your job is to stay on. If you fall off, you don't get paid. If you hold on but break your risk limits, you still don't get paid because you'll be forced out. So how do you stay on? You size properly. You take some chips off when the ride gets wild. You keep your hands strong and you keep your emotions weak. And then he said something that should relieve anyone who thinks, I can't sell because it might go higher. He said he has owned positions that ultimately became huge winners, but during the journey, they still dropped 50% at times. He said he has seen 10-bagger outcomes in companies that still put investors through drawdowns that would make most people quit. So the goal isn't to avoid drawdowns. The goal is to avoid drawdowns that force you out. Let me push on the late stretch phrase, because viewers hear that and immediately want a single indicator. What are you actually looking at? Company builder, price and behavior. First, price. When metals are printing levels people used to call fantasy, you have to assume a lot of future good news is already priced in. Second, behavior. When every conversation becomes, how high can it go? That's late cycle language. Cycle historian. And you watch the velocity. A steady climb can be healthy. A vertical move is usually the market rushing to price something all at once. When the move compresses into weeks what used to take years, the market is telling you it's overheated, even if the long-term thesis is still alive. John A.G. So you're saying it's not about predicting a date, it's about recognizing the temperature. Macro thinker. Exactly. A market can remain hot for longer than you think. But if you pretend the temperature isn't rising, you'll touch the stove with a bare hand. Then the cycle historian adds something I think is the most underrated signal: attention. He said, when conferences like this start feeling crowded, when new newsletter writers pop up every week, when every chart thread turns into a victory parade, you're no longer early. You're in the part of the cycle where the crowd is finally arriving. And here's the part that made the whole room nod. He said the worst tops aren't marked by bad news. They're marked by maximum confidence. That's why the old stories matter. He reminded the room of those historic boom and bust moves, periods where gold and silver felt unstoppable, only to collapse fast and then grind down for years. He didn't present it as doom. He presented it as a warning label. Now, another panelist jumped in with a front-loaded idea that hit me hard. He said, sometimes a bull market delivers several years of expected gains in one single year. It's like the market steals returns from the future. Everyone celebrates, but the bill shows up later in the form of a long correction or a deep pause. He compared it to expecting progress across multiple future years and then watching it arrive early. His point was simple. If returns got pulled forward, don't be shocked if the market needs a bigger reset than a normal pullback. And that brings us to the phrase he used, not just a rest, a real break. When you say break, what does that mean in numbers? Cycle historian. In this sector, a break can be savage. 30% is normal, 40% happens, 50% is not rare. And the cruel part is that it can happen while the long-term story stays bullish. Company builder. That's why you don't marry a chart. You date it, you enjoy it, but you keep your options. Then the macro thinker added the other side of the argument because he didn't want the audience to leave with only fear. Macro thinker. Also remember, the sector can still be underowned. Globally, precious metals and miners are still a small slice of allocation for many big pools of capital. If capital rotates, even modestly, the upside can extend. Cycle historian. And it's not just gold and silver. When money starts looking for real things, it often finds its way into other hard asset themes too. Copper came up on the panel as a critical metal with its own demand story. The point wasn't to chase everything. The point was to recognize that late in a macro shift, capital can fan out across the resource complex. John Egg. So the answer is not panic. The answer is prepare. Exactly. And if you think you'll get a warning before the turn, remember, markets don't ring bells, they yank rugs without mercy. Now, the macro part of this panel matters because it explains why people think this cycle could be different. The macro thinker on the panel brought up a thesis about real rates and the dollar. He said, when inflation runs above what savers earn, currency purchasing power erodes. It's not an opinion, it's arithmetic. Then he made the bold claim. Over a decade, the dollar could lose something like 75% of its purchasing power if negative real rates persist and policy remains the same. That sounds extreme. What does that mean for the average investor watching this? It means the playbook that worked for 40 years might not work for the next 10. If you lived through a golden era for long bonds, you might be walking into a different era now. So you're saying long-duration bonds could be a painful place? Over the next decade, yes. If the regime shifts, the winners change. And then he said something that surprised the room. He said he actually hopes gold goes down, not because he hates gold, because gold going up often means confidence is going down. Gold is an asset that shines when people are scared about paper savings products, about fiat, about stability. So a roaring gold market is not always a happy story. It can be a warning light. Then the company builder added a debt perspective. He said debt to GDP is climbing. Not just one country, many. When debt grows, governments look for ways to manage it. Sometimes that means inflation. Sometimes it means policies that quietly tax savers. Sometimes it means currency dilution. And when that happens, people start searching for places to park value. Hard assets become part of that search. He also made a capital flow argument. The global pool of debt and financial assets is enormous, while the mining sector is comparatively small. So if even a small portion of big money decides it wants exposure to hard assets, the sector can move violently because it can't absorb that flow smoothly. That is why late cycle moves can feel like a rocket, but rockets also run out of fuel. So we're back to the core tension. More room to run, but higher risk while it runs. Now, the panelists disagreed on timing, but they agreed on process. The process is, take a portion of profits, keep some exposure, and prepare mentally for the shock days. And then one panelist explained how he personally uses social feedback as a contrarian tool. He said, when he trims into a melt-up, people get angry online. They call him weak, or scared, or wrong, and he uses that outrage as a sign that the crowd is overextended emotionally. Now, again, that's not a universal indicator, but it reveals something important. When everyone is euphoric, the person who sells a little looks like a villain. And when everyone is panicking, the person who buys a little looks like a fool. That's the game. The question is whether you can tolerate being uncomfortable long enough to make rational decisions. Now we move into the profit-taking mechanics, because that's where the audience needs clarity. When you say, sell a portion, what portion? How do you decide? Cycle historian. You decide based on risk, not based on prediction. If a position is so big that a 40% drawdown would damage your life, you cut it. If your position is reasonable, you can trim less. The goal is to avoid being forced. Macro thinker. And you can structure it. For example, you might sell 10% at certain milestones, or you might sell enough to recover principal, or you might sell when the chart goes parabolic. Company builder. The key is doing it while you still feel good. When you feel bad, your decision quality collapses. Now, this is where the panel gave a vivid example with physical metal. One panelist said he trimmed a large share of his physical silver during a sharp run, something like 80%, not because he thinks silver is dead, but because his job is not to catch the last 5% of the move. His job is to capture the thick middle of the move. He said in essence, I don't need to be perfect, I need to be consistent. That is a professional mindset. Now, if you're a long-term stacker and you never sell, that's your choice. I'm not telling you what to do. But if your goal is performance and survival, you have to respect that parabolic moves often correct. And here's a cliffhanger that should keep you watching until the end. The market doesn't punish you for selling too early once. It punishes you for refusing to sell at all. Now we transition to the company spotlight portion of the panel. And I'm going to say this carefully because this is where people tune out. Don't. Because company segments reveal how operators think in late cycle markets. They reveal capital allocation, balance sheet decisions, and the difference between story time and execution time. First, Dakota Gold, focused on a South Dakota's homestake district. The pitch was essentially, this is an old camp with serious history, but modern exploration has been limited for decades. The team controls a large land package, about 48,000 acres, much of it on private ground. They believe private ground matters because it can simplify parts of the permitting path compared to federal processes. They also emphasize that the jurisdiction is not theoretical. It's a place with a long mining history and a culture that understands mining. They highlighted the Richmond Hill project, pushing it toward production, framing it as one of the next U.S. gold projects that could move forward in an environment where domestic supply matters more than it used to, realistically. They also pointed out that the broader district historically produced more than 40 million ounces, framing it as fertile territory that has not been modernly explored for over 30 years. Now, does that guarantee success? No, but it shows what investors are hungry for late in a cycle. Quality assets in safer jurisdictions with experienced teams and a realistic path. Then we move to Equinox Gold's story. A founder described building the company in Vancouver over 8 years with a goal of reaching meaningful annual production. He described being near the million-ounce mark previously, then highlighted a $1 billion Brazil sale that boosted liquidity, cut debt, and put market cap near $16 billion today. He gave forward production guidance in the range of roughly 700 to 800,000 ounces, spread across multiple countries in the Americas, Canada, the United States, Mexico, Nicaragua, framing it as diversified operations rather than a single asset gamble. But the most important part of that pitch wasn't ounces. It was debt. He talked about having had roughly $1.5 billion of debt not long ago, and aiming to bring net debt down towards zero by the end of the first quarter of this year. Again, I'm not verifying that. I'm telling you the story. Clean up the balance sheet while pricing is favorable. And then he said something only strong companies get to say. The next challenge becomes capital allocation, what to do with free cash flow. That is a good problem, but it's also where many companies make their biggest mistakes. Overpaying for acquisitions, greenlighting the wrong build at the wrong time, chasing growth because the market rewarded growth yesterday. So you can listen to that and ask, will management stay disciplined when cash is easy? Because cash being easy is exactly when discipline gets rare. At the end, another panelist added a perspective that tied everything together: trust. He said the best operators in the room have spent decades building credibility. And late in a market, credibility matters more than ever. Because late in a market, you don't want to be holding a company run by amateurs. Late in a market, weak balance sheets break. Late in a market, promotional stories get exposed. So the message was quality first, liquidity second, story last. Now, I want to add an important note for you watching at home. When people call a market a bubble, the most dangerous reaction is binary thinking. Binary thinking says, if it's a bubble, I must sell everything. Or, if it's a bull market, I must buy everything. Professionals don't think that way. They think in probabilities. They think in ranges. They think, if the market keeps running, I want exposure. If the market snaps, I want survival. That is why scaling in and scaling out exists. That is why trimming is a skill, not a betrayal. Now, let's get very specific with a scenario. Imagine you bought a mining stock at $1. It's now at $4. You feel brilliant. Your friends start asking questions. Your timeline shows people posting rocket emojis. Your brain starts calculating what happens if it goes to $10. Now ask the question that the panel wants you to ask. If it drops from $4 to $2, will you panic? If it drops from $4 to $1.50, will you freeze? If it drops from $4 to $1, will you swear off investing? If any of those answers are yes, you're too concentrated. So what does trim look like? It could be as simple as selling enough shares to get your original capital back. Now your remaining position can still participate, but your life is not tied to the next pullback. Or it could be selling 10 to 20% into strength, building a cash pile so you can buy when the market offers discounts. Because, and this is key, late cycle pullbacks are where fortunes are made, if you have cash when they happen. Now, we still haven't talked about what makes this cycle feel new world. And the panel had a strong point here. The company builder said, today's markets are influenced by forces that did not exist in the same way decades ago. Crypto flows, meme stock behavior, AI hype, passive index investing, algorithmic strategies that chase momentum, retail participation that can appear overnight. These forces don't only affect tech stocks, they affect everything. They change how quickly money moves. They change how quickly narratives spread. They change how quickly risk can go from ignored to priced. And that's why volatility can be extreme. Now, the panel also acknowledged something else. Even with those new forces, the old rules still matter. Demand and supply still matter. Cycles still matter. Human emotions still matter. So the smart approach is to combine respect for the new speed with respect for the old patterns. Now let's talk about cycles, because one panelist gave an 8-year wave idea. He said many commodity cycles tend to run roughly peak to peak or trough to trough in that kind of time frame. Not perfectly, but as a rhythm. He pointed out that if you anchor this gold bull market from its lows around the middle of the last decade, you're already deep into the cycle. Gold has multiplied several times from that area, and mining equities have finally started to catch up. He described how, for a while, there was a disconnect. Metals were high, miners were sluggish. Then, more recently, the miners caught up in a hurry, as if gravity finally pulled the relationship back to normal. That catch-up is exciting, but it is also why the room called the market frothy. Catch-ups are fast. Fast moves create stretched positioning. Stretched positioning creates the conditions for sharp pullbacks. So, again, the message is, the trend may continue, but don't pretend the ride will be smooth. Now, let's bring this home with action steps and cliffhangers, because I want you to finish this video with a plan. Step 1. Decide your risk number. What is the maximum drawdown you can tolerate without making a forced decision? For many people, it's 20%. For many, it's 30%. For some, it's 50%. Be honest. Step 2. Compare that number to the reality of this sector. If you own junior miners, 50% drawdowns are not a weird scenario. They are a normal scenario. So if your tolerance is 20%, you either size smaller or you don't play. Step 3. Choose a profit-taking method. Method A. Principal recovery. When your position doubles or triples, sell enough to get your original investment back. Method B. Laddered trims. Sell small portions at predetermined levels, regardless of emotion. Method C. Portfolio cap. Don't let any single position exceed a certain percentage of your portfolio. Pick one. Combine them if you like, but have something. Now, 2 engaging questions for the comments, and I want real answers. Are you in hold through anything mode, or are you in trim to survive mode? And do you believe the next big risk is a sudden crash, or a slow, grinding bear market that bleeds people out over years? Drop your answers below. Because the final warning from this panel was not, the bull is dead. The warning was, the bull is dangerous. And the most dangerous moment is when everyone believes there is no danger. That's when the market flips the script. So stay alert, stay disciplined, keep a plan. And if you want more breakdowns like this, subscribe, and I'll see you in the next one.